Hey guys, continuing this series on tax planning. Now we've kind of walked through the uses of money. Basically, there's only 4 things you can do. You can save it, you can give it, you can grow it, and you can owe it. Today we're at the O, and we're really just talking about debt, how to use it, how to leverage it, how to think about it as part of your overall plan and tax planning. As always, this is not personal financial, tax, or investment advice. It's just for education. So first, I want to say right out of the gate, I am not one of the people that thinks that all debt is bad. I do think that if you know the implications and you think through your overall strategic financial plan, I don't think the goal is to just get debt free as fast as possible. Now, for some people, that may absolutely be the right track, but it really depends. So let's just talk about how I would characterize good debt versus bad debt, especially when it comes to tax planning. Now, when it comes to consumer credit card debt, it's almost always bad if it's revolving, and here's why. There's really no tax benefit to having a running credit card balance. You cannot deduct the interest on your taxes. As opposed to that, if you have a student loan or you have a mortgage, there is at least something there that is coming back to you in the form of a tax deduction, subject to certain limitations. Now, I'm not saying that you should run up as high of a student loan bill as you can or get the largest house that you can, but I'm simply saying credit card debt is very, very destructive. The interest rates work against you. It's compounding growth in reverse. So first of all, that's commonly the thing that I see that ruins a lot of financial plans. So beyond that, let's just kind of talk about owing in general. So you have to make decisions based off of what would be the trade-off. So every form of debt or debt leverage comes with an opportunity cost. Those people that paid down and bought their debt off as soon as possible also gave up a lot of capital that they could have put in to something that could have grown in the future. Same thing, if you own a business, you're putting a lot of money into your business and you are actually betting on the return of that business outside of your returns in the stock market. So when it comes to debt, it's about leveraging something for something greater. So you really need to look at that in the tax implications of the returns. And this is really a nuanced field. So I'm not really coming with a couple hard and fast rules here when it comes to owing, but it really comes down to how does this interact with the other parts of your financial plan? And in my opinion, owing becomes a lot more important when you get to a restrictive income environment, meaning when you approach retirement. It's much easier to have forms of debt service when you have ongoing earned income that increases. When you approach retirement, it's very difficult to have ongoing debt obligations and make sure that you have a stress-free and worry-free retirement. So I hope that's helpful. I'll see you next time.